Hello, good morning, everyone, or good afternoon, depending on where you are. This is the TradeStation Masterclass, and today we are going to talk about Optionstation Pro Search tab. So before we jump over to the topic of today's presentation, let's go through some of the disclosures that are required for every single live session. Keep in mind that every symbol and idea that I talk about is for educational purposes only. It is not a recommendation of TradeStation. Also, that active trading is not suitable for everyone, especially if you're trading options which carry a higher degree of risk, and past historical performance is no guarantee of future results. Please go to our website at www.tradestation.com if you need a little bit more information on these disclosures. All right. For those of you that don't know me, my name is Jesus Nava. I'm the Director of Client Training and Education in TradeStation, and it's always a pleasure to talk about the TradeStation technology. So let's go ahead and get started. I'm going to switch over to my TradeStation platform and talk about this feature that we don't highlight many times. And I was trying to, work on simple examples to show you today. And it's very interesting the amount of information that you can gather from tools like this. This is a search tool. The whole intention of designing this tool is to help you identify positions that would provide you with the best result based on a specific outlook. So you do have to provide the tool what you think it's going to happen to the market. So it's all based on what your assumptions are of what is going to happen to the market. So whatever information you plug, then the tool will return whatever positions would work best under those circumstances. So very specific to the circumstances you provide. So it's not like we are suggesting for you to trade certain positions. It's just based on math and calculations that are happening in the background. It does require you to take a look at those calculations with a grain of salt and just making sure that that is exactly what you want to trade. So I don't want you guys to utilize this tool blindly and saying, hey, this is what Optionstation Pro told me to do, because that's not the way that the tool is designed. So we're going to go through a lot of information, a lot of things that you have to plug into the search in order for this to work. So let's go ahead and get started. I'll show it to you, and you will decide whether this is something you want to use or not. I'm going to go here to the apps, and I'm going to go to Optionstation Pro. All right, let's take a look. So Optionstation Pro pulls up. As you can see, it opens up on the search tab because that's what I was looking at before I started the class. But that's where you find the search. Just look at the very bottom left of your Optionstation Pro. You're going to see 4 tabs. I'm talking about the last tab titled or named search. This is where the tool is. This is what we're going to focus our class on today. And before we continue, since I already have a position on AT&T, I'm going to load up an underline on which I don't have a position. Let's go ahead and try. What's GE trading at the moment? Okay, so that's General Electric trading at $102. Okay, that's fair. I like that. It's a kind of a round number. So before we use the search, let's go ahead and talk about briefly about some of the things you can find out here in Optionstation Pro. At the very top, we have information on General Electric. A couple of things that I like to look at all times, even when I'm doing a search, is historical volatility. This historical volatility that you see up here, the 28.81%, that is historical volatility based on price movement of General Electric for the past 90 days. So it just gives you an estimation on how much the price can move up or down based on how much it's moved historically, specifically 90 days. I also have a position column, which is blank. Very good indicator that I don't have a position open on General Electric, but this historical volatility is going to play a factor into some of the calculations that happen on the search tab. Okay, so here, if I go to the options tab, you're going to find options for General Electric. These are the option chain. If I collapse the chain, the rows that are highlighted in a brighter shade of gray, those are my monthly options. So I'm going to focus on options that expire in February, just to set up an example that has at least some time to develop. You know, if I were working with the January options, these are expiring, you know, in about a couple of weeks. You know, they expire the 21st of January. And the example that I have for you guys is a trade setup that has a holding period of over 30 days. So that's why I'm looking at the ones that are here in February. Not that you have to come here and select options from the February category, but it's always good to have a starting point, you know? So this is information that you have to be aware of even before you jump over to the search. You need to know what price the underlying is trading at, you know, what sort of historical volatility we're dealing with. We look at the strikes right here for the options that are expiring in February. We can see that the strike of 100 on the call side, those calls are being sold and bought for about $5.50 and $5.70. On the put side, it's a little bit cheaper. The 100 strike price is being bought for $3.45 and sold for $3.55. So we can see a little bit of difference in the prices. The prices here are going to be crucial because that's going to be your cost. If you do decide to buy a call or a put, you know, those prices are going to be pretty much what your premium is going to be. So it's important that we always look at those values as well. All right. So let's start our setup here. Sorry, my phone was ringing and I just muted it. Let's talk about what the search can tell us. Let's set up an outlook. Let's say that we are bullish. In most of my examples, I always say that I'm bullish because it's easy to, you know, figure out the math in my head. When it's bullish, you know that you have to buy low and sell high, right? So my outlook on General Electric in this example, it's bullish. And whenever I'm trading options, I want to trade with limited risk. Of course, options is a totally, you know, open world, and you can be as risky as you want to, or as your broker allows you to be, right? But it's very risky business if you're not careful as to what type of options you're trading. So whenever I do an example, I tend to choose bullish, but with limited risk. So let me go over here to the search tab. I'm going to go to the search tab, and here you can see at the very top that you have already some information established. Right here on the top left corner, you have current settings. We see the asset is General Electric, and you can see the current trading price right there. It's trading at $102 and a penny. You also see the asset volatility, the 28.81% that we saw right here at the top is brought over here because it's a important value used in the calculation for the search. You have the model. This is the options pricing model, the Jerkson and Stenland. You can change that if you want. This is a very common pricing model to use. If you're used to other calculations, you can change the model if you want to. Where do you do that? You have to go to the main settings page of Optionstation Pro, go to the option chain, here to the common category here on the left-hand side. And here's where you find the pricing model. You can choose between two, Black-Scholes or Jerkson and Stenland, okay? I'm gonna leave it the way it is. I just wanted to point it out so that you are aware that you can change the pricing model, especially if some of the calculations are not matching other providers. It could be related to the fact that we're using a different pricing model. All right. Strike proximity 5 and expiration all. We can change that if we want to. In fact, let me increase the strike proximity. Strike proximity is how many bids, I'm sorry, how many strikes above and below the current trading price you search for. Because remember, whatever it says here is the data that we're supplying the search to filter for. So if we want to add a little bit more, make sure you do that before you run the search. How do we change the strike proximity? We go back here to the option chain. The strike proximity is clearly seen right here. We only see 5 strikes and 5 strikes below. So I'm going to go here to the strikes column or drop down, and I'm going to change it to 20. That way, I get a little bit more. I get 10 above and 10 below. Now, if I go back to the search, now you can see how the strike proximity is changed to 10, because whatever you load up in the chain is what the search is going to use to filter and provide you with the results. Okay, let's go over to the next box. This is the strategy. This is what you're going to use as your starting point when it comes to searching for options. The strategy here says bullish limited risk, which is the one that we talked about just a moment ago. And that's the one that I want to use. But if I go to the scroll down, and if I hover over bullish, notice that I can also opt to choose, the unlimited risk, which I'm not a fan of. I like to limit my risk. I'm not sure what type of options trader you are, but you have to choose your outlook carefully, because we don't want you to, have to be exposed to unnecessary risk. And it's very important that we are careful in what we do. Although, the search tab will not take you into trades unless you manually say, I want to trade this. This is pretty much safe, because it's all about searching information, analysis, and trying to determine if it's something we want to use or not. But we have the other strategies like bearish, if you're trading in an active market or something that's moving sideways, we have a quiet market right here. Or if you want to trade specific options strategies, you have them all here. So if you recently learned about butterflies and you want to trade butterflies, but you need a little bit of assistance on what would be the best butterfly to trade, you can pick a strategy here. I'm going to keep things simple just for presentation purposes and not lose you guys. And we can all understand what a bullish outlook is with a limited risk. You can see that right below the drop down, once we select bullish limited risk, it does tell you what type of options strategies this is going to look for. It's going to look for put verticals, like a sell put vertical, a buy call vertical, or just a straight buy call. And of course, these are limited risk positions. You're not selling naked. You can see what you're selling is just a vertical, and that has some limited risk. So all the positions that this tool is going to look for will have that characteristic. The strike interval, of course, you can choose it here. I'm going to, just look at single calls or single puts. So the strike interval is not really important, or makes no sense here. But if you're trading verticals or other types of spreads, then the strike interval will have an impact. Okay, so that's my strategy. Now it's the market outlook, is the box right over. In the market outlook, of course, you have to tell Optionstation Pro what you think is going to happen to the market. This is where you plug in your expectations. Of course, everybody has different expectations. So let's go through an example. This is just for educational purposes. But let's assume that we think General Electric is going to go up. And we think it's going to go up because we already said that our strategy is bullish. It makes no sense to pick a bullish limited risk if we think that the price of General Electric is going down. So how much do we think the price is going to go up or down? Let's put here the projected asset price. We're going to say that it's going to go up by 20%. So we're bullish, and we think that General Electric is going to go to 122. This 122.33, it's automatically calculated based off the percentage that you put in here. So 20% of 101.92 comes out to be 122.30, just does that automatically. So you have at least the detailed target price that you are shooting for. Then we come to the trade closing date, because you do have to tell the search when are you expecting to close the trade, because depending on the closing of the trade, then it has a little bit of flexibility on choosing different options with different time span. Of course, time is a very important factor in the valuation of an option. So by us letting the search know when are we planning on closing the trade, then that information is used to present different options strategies. Let's suppose that we think the 20% target is going to be reached in about, from 30 to 45 days. We're talking about a month and a half. So what we're going to do is we're going to go through the drop down here. We're not going to close the trade tomorrow. That's what the date shows up here, January 8th. We're going to go here to February, and we're going to hold that until mid-February, Friday, the 18th. I think it's the day that monthly options expire. Okay, so we're going to choose that date. We're going to hold the trade until that Friday. And notice that it tells you how many days until that date is 42 days. Now, if you want to change the volatility, here's asset volatility change. You can supply a percentage by which the volatility is going to change. That's only if you think the volatility is going to change. As it is, volatility here for General Electric is already at 28%, which is not, extremely high or extremely low, but it's, moderate. So I'm going to leave it the way it is. So I'm going to leave the asset vol change. I'm just going to leave it on 0, which means that it's going to use the current historical volatility of 28%. Based on, and this is interesting, based on that volatility of 28%, General Electric is expected to trade between $76 and $136 in those 42 days. Based on what General Electric has done in the past, yeah, there are chances for General Electric to drop to 76 or to go up to 136, which is a good indication that our target price right here at 122 is within this range. Now, if I were to change this to 50%, that's 500%. If I were to change that to 50%, like an outlook of 50%, thinking that the price is going to go up 50%, bullish to 152, we can see that based on volatility, that we are outside the range of prices that General Electric can be in. Of course, if we think that the price of General Electric is going to go up to 50 or go up by 50%, we need to also factor in some volatility change. Otherwise, we are outside the range. If we think that the volatility is going to increase by 20%, now it's going to go to 34%. Now we are getting closer to that target. Here, the volatility would have to increase by 30, 40, would have to increase by 40% for us to be within the range of prices that General Electric could move to and at least have some realistic target expectations. So notice that as we change the values here, everything else is changing, and we just have to account for that. So I did say that it was only going to be 20%, and volatility is going to be the same. So that tells us that we're still within the range of price movement. Right here on the right-hand side, we have some filters. This includes all sorts of strategies, calls and puts. If I want to exclude selling strategies, I can just uncheck that. Let's just say buy strategies. Those are the ones that are probably going to have the less risk because you're not shorting any options. Okay, so do we want to include puts? maybe for this exercise, since we're bullish, I'm just gonna concentrate on buying calls, the buy side calls. So I've unchecked some filtering here. Right here on the far right, you have to tell the search, what is it you're searching? What is your fitness criteria? What is it that you want to base your search on? The default is projected profit. It's looking for the options positions that would provide the most projected profit based on your market outlook. Let's go ahead and leave it the way it is, and I'll show you some other options once we start making some modifications. Number of results, I have 100. You can limit that if you want. I'm going to limit that to just if I limit it too much, then I don't, because I want you guys to see some very interesting information that I was able to see earlier. So I'm going to go here and leave it on 100. I'm going to run the search, and notice within seconds, this search is providing me information on what it thinks is the best position to trade based on the market outlook. Now, of course, the one at the very top is the one that is going to be the one that provides the most projected profit. Let me open up this column. This is projected profit right here. Notice that the one at the very top has a projected profit of $2,010. But the problem with the very top one, and this is something that I realized when I just opened this up, yes, it provides you the most projected profit, but at what cost? Because it's important that when we trade options, we're also considering how much is it going to cost us to trade what this is suggesting. Take a look at the maximum loss here, 4,210. That's massive. That's a massive loss. If I think about it, I'm risking double the amount that I'm trying to get, which is $2,000. You can see the price of this option is $42.10. That's not cheap. So in a real world, if I wanted to, trade something that capitalizes on my market outlook, yeah, the top one is not going to be the one that I would pick. In fact, let's go ahead and analyze this a little bit further. So the top one is a single strategy. Let's go here and take a look at the description. This is a single one. One of the things that I noticed here is that in the description, it doesn't tell you what year the option expires in. It tells you the month and the day. So this is March 18th, and this is a $60 strike. Let me see if this is scrolled all the way to the top. It is. Always take a look at the scroll and make sure that you're scrolled either to the top or to the bottom or somewhere in the middle. Just be aware of it. And because sometimes I noticed that I was looking at some information and I wasn't scrolled all the way up or down, and it wasn't really the information that I was looking for. So yes, here in the description, we don't get the expiration year. So that's something that I missed. Maybe I need to talk to engineering so we can include the expiration year there. I had to further analyze this suggested position so that I can see the year. All right, so the price is $40.10. That's from the chain. Of course, that gives you a maximum loss of $4,210. That's only if you're trading one single contract. So that's another thing, which gives you, leverage over 100 shares. It's going to cost you $4,200. I mean, that's a big chunk of money. Of course, the maximum profit is infinity. All right, we have here something called profit loss ratio. Here's projected price of the actual call that you're trading. If you're trading a call and it's going to cost you 42, it's expecting the call to go up to 62 so that you can make those $20 per share or $2,000. You have the probability of profits. This is expected value. Then you have delta, rho, theta, vega. So you have a lot of information about this particular position. So how do I further analyze this? At the very end, if I scroll to the very right, you're going to have an analyze button that I can click on, and it takes me to the analysis tab for me to do further analysis. Now, this is a graph, a position graph of this call. And if you look right here at the bottom, this is where you find the expiration. Expiration is March 18th of this year. So it is an option that expires this year. It has a strike of $60. And it has, of course, the price here is 42.05. So the maximum loss, it is indeed 4,205. So this is what's going on. Let me go ahead and remove all these slices. This is a graph. You know, the strike price is down here, $60. So as the price of the underlying goes up, of course, better for you. Now, when or what price did we say that General Electric was going to go up to? I think if I go back here to the search, our projected asset price is 122.21. So I'm going to come back here to the analysis. I'm going to add a price slice, and I'm going to set the price to 122.21, which is my expected target price. Let me push the graph here in a little bit, because I don't see 122.21 cents right here in the graph. So I'm going to take my graph from the prices right here at the bottom, and I'm going to squeeze it in. Where is this going? I have this shade right here. I can continue to drag it down, but all right. So, this makes no sense, but we'll take a look at some of the calculations here. This is just based on, let me just try to make some sense out of this. This is March 18th, 2022, because what I'm looking at here is this shade of gray. So you guys know exactly what I'm looking at. I'm looking at the shade of gray right behind the graph. And what I'm trying to understand is probability of price movement, because maybe it's got to do with the fact that this is a call with a strike of $60 when the security or the underlying is trading at 101. If I change the strike here to something closer, let's say that I change it to 100, still has all this upward movement. That's pretty odd. What's going on here? Something's going on here that I'm not able to understand because of the shade of gray here. Probability of movement for General Electric is based on historical volatility. Now, my historical volatility is 28%, but that does not translate into this huge shade of gray that I see here in the background. Okay, so maybe let's go back here to the 60 strike price, because I mean, looking at this is a very tough, position to get ourselves into because of the price. Yeah, but still, I see your point, Barton. Barton is just making here a comment in the chat. It says the graph is giving the profit loss, not expectation. That's if you're looking at the actual line. For example, the green line, of course, is going to give you, not the green line, the actual, yeah, the green line, the blue line is the one that expiration. So the blue line is going to give you the profit and loss expectations. But the shade of gray here in the background is based on historical volatility, and it's just the probability of movement of the underlying. Now, if I were to trade something, let me remove this for example, let me delete that position. Let's take a look. Historical volatility here is 28%. Let me go back here to my options. Let me see, I'm looking at February. Let's say that I trade, I'm going to right click here and analyze this as a buy single. So this is more, it makes a lot more sense, you know. So let me go here. And I'll tell you exactly what I said, why I say that, you know. So I have a shade of gray here that is based on standard deviations of movement. I'm just opening up my graph a little bit more so we can see more of the graph. I know that I squeezed it way too much because of that weird shade of gray. So this is what it's happening. The shade of gray is just a probability of movement based on historical volatility. So if you see right here, if I go to this drop down that says pinned, and I pin it to standard deviations like one below and one above, you'll see how the price slices will line up with the size of the shade of gray. So based on the one standard deviation calculation, this is a 68% probability that the price will be within these prices. If I take this and I change the expiration to March 18th, which is March 18th, I think it's it is a monthly expiration. This is March. You see, it opens up that shade of gray so much bigger that I'm not really sure why. It's got to be something in the calculation that's throwing it off. So February looks normal. Let me take a look at March here. March 18th. We're talking about the 60. Is it because of maybe it's just the pricing of the option that's throwing that off? Okay, let's go ahead and take a look at other things. So it's important that we bring in whatever is it that we're trying to look at. It's important that we bring in that option into the analysis tab, because it'll clear up the idea of whether we want to use that or not. You know, in my opinion, and this is a humble opinion, but and again, this is not a recommendation, it's just an example. But in terms of risking, capital and risking your premium, it just makes no sense to risk $4,000 for a projected profit of $2,000. Doesn't make sense in my head. But then it's up to you to decide whether you want to trade something or not. Well, let's go back here. Let me right click and delete that position, because you can delete any theoretical position. And let's go back here to the search, because there's a couple of things you can do in here to try to find something that is tradable based on your trading style and based on your capabilities. So if you want to sort this result on other columns, you can. So if I sort by maximum loss, and now I do have to look at the scroll bar here. The very one that has the most maximum loss is right here at the top. If I click on the column header one more time and I scroll all the way to the top, I'm going to see the one that has the least maximum loss. So notice that maximum loss here in relationship to the projected profit. Now, of course, I'm not looking at a position that has a projected profit of $2,000, but talking about risk and maximum loss in my type of trading, my trading style, which is not a recommendation, is a little bit more tolerable. So here, let's say, for example, that I look at a projected profit here of $1,000 and maximum loss of 179. So if I click on the Analyze Here button on the right, it's going to send that over here to the Analysis tab. And this makes a little bit more sense than the one we were looking at, with that weird, probability of movement. Now I'm looking at this shade of gray, and based on volatility, it's expected for General Electric be between 93 and 111. It's not the price that we are targeting, which is 122. In fact, let me add another slice here, and we'll make that 122.21. So we see we're all the way out here on the right field. But again, this deviation, if we were to increase the standard deviations to 2, we are, within the range of that price movement. Of course, it can go down or it can go up. But the nice thing about this type of position is that our maximum loss is $177. Does that make sense? So now, if we wait until expiration, let's go here, plot number 2. Let's go to plot number 3, which is plot number 2 is expiration. So it's right there inside brackets. It says DTE, which is days to expiration 0. So if General Electric were indeed to go to $122, that gives us a theoretical P&L of $1,000. And our maximum loss on this particular trade is 177, regardless of how wrong we were. If General Electric, instead of going up, goes down even to $50, drops 50% of its value, we're still only losing $177. So what I'm trying to say is that if you go to the search tab and it gives you, all these results, make sure that you are sorting by other columns, because the very top one may not be the right one for your type of trading. All right, let's go and take a look at some of the comments here in the chat. Let's see, can we do a simulation with SPXW, assuming that volatility will drop to 17 2 weeks from now? I think SPXW is high and can drop. Yes, we can do a simulation like that. For example, let's change the symbol. So the symbol is $SPX.W. Is that the symbol? No, that's an invalid symbol. Is it SPXW.X? No, what is the symbol? The exact symbol what is the underline is what I'm trying to say. SPX.X. No. Do we know it? Sign SPX.X works. These are the, okay, so SPY is the ETF. So we have options on the ETF, which is SPY, and we also have options on the index. So if you pull up $SPX.X, these are options on the index, which is, we can use them, These are all monthly options. Let's take a look at the ones that are expiring in March. SPXW.X. Yep. $SPXW.X. There we go. So that's loading. So the example you wanted to see is that volatility will drop to 17 2 weeks from now. So if you go to the search tab, let's say that we would have to fill in all the information again, what our strategy should be, what the market outlook should be. If you think volatility is going to drop, Barton, what effect do you think that it will have on the price? Because that's what we're trying to determine here. Now, if we want to leave things open like an active market, considering that price goes up or down, we can do active market limited risk. But let's say that the price will go up, so we'll say bullish limited risk. Okay. Do we have a projected asset price that we want to test? We can say it'll go, up 10%. That's a pretty hefty movement, right? 5% movement. You did say that the volatility, now the volatility according to this is 13.95. Do you think that that is accurate? So 3% takes us up to 48.32. So this is a 13.95 historical volatility. If we go over here to our settings and we go to the common, historical volatility bars back is using 90 days back. Maybe if we limit that to 30, let's see what happens. It does go up. So in the last 30 days, about 18%. Does that sound a little bit closer to what you're looking at? Because this historical volatility calculation, as you can see, is directly linked to the number of bars that we're looking back. And it was looking back 90 days. So maybe this symbol was not as volatile as it is right now. And that's why it was at 13. So I changed it to 30. And now we have, closer to 19%. And we can say that it's going to drop by 10%. I'm sorry, minus 10%. You can see that if we put in negative 10, we are expecting the volatility to drop to 17. All right, so if we want to do a trade close of 10 days, we can do, maybe go back here to January. Today's the 8th. Let's suppose that we want to take that until the 18th. And what would you like to rank the results by? Projected profit? Because if I go to the drop down, this is something that I wanted to show you. You can search for positions based on projected profit, or you can do other things. You can use the Greeks. You can use, the maximum risk or the maximum reward. You can also do a search by probability of, profits. Let's just do projected profit and see what we get. I'm going to run the search. Again, here we have a projected profit of $10,000. Now, this is, of course, in relationship to my maximum loss. When I take a look at my expected profits, I want to know what my risk is. And maximum loss, of course, is a risk. Now, of course, this sounds really interesting. You could make $10,000 in just one trade, but at what cost, right? That's the big question. Now, if we sort by maximum loss, we got some hefty losers there. Okay, and we know that these are options that are expensive, and we just have to account for that. But notice that we have different profiles here with a lesser, maximum loss. And again, you can sort by probability of profits. You can do all sorts of things here in the search, and find, things that you probably didn't think you could trade. A lot of times we look at strikes that are within proximity of the trading price, and we don't look outside of the box. But this type of tool does allow you to see other things that you probably were not seeing. Like, for example, this one right here. Let's go ahead and analyze this one. So we take it here to the analysis. You can see how the price of this is a call. The single call expires, January 19th. The strike is 47.12 or 47.15, I'm sorry. And the price is $33. Cost is, of course, $3,400. Again, look at all the different probabilities, where the price is expected to go, where you think the price is going to go. But it's an interesting way of looking at information that you hadn't seen before. Okay. Okay, so the best way is to do a spread or a call spread. Interesting that you say that. If I go to the search, of course, at the very top, these are all going to be single calls. If you want to do spreads, what I would do is, sell put vertical, buy call vertical, buy call. Maybe if we do a specific spread, you can just search by specific spreads if you want to do that. If you want to do verticals and search again, then it builds spreads for you. So you have a maximum loss and a projected profit over here. So it's very, very flexible. I would be very interested in knowing if you guys like the functionality, or if it helps you in any way. For those of you that are options traders and spread traders, this would be great to find out if it's something useful or if you think that it's not useful at all. But let me know, send me an email if you want to provide some feedback. You guys know my email, jnava@tradestation.com, and you're welcome to email me. And if you find an issue or a problem, please let us know, and we'll also get our engineering department to take a look at that, all right? But this is the end of the presentation. I wanted to present it to you, and hopefully you guys like it. I want to say thank you for your time. Thank you for your participation. It makes the class very interactive. I hope everyone has a wonderful weekend, and I'll see you guys on Monday. Monday, we have our next masterclass session at 12:30 p.m. Eastern Time. Goodbye, everyone. Great having you. Bye-bye.